Thank you, Giles, for that introduction, which I suppose sets the bar fairly high. Makes me wonder whether it's a good thing or not that I won't be around to hear tomorrow morning what you guys say about my presentation. Some of you probably have heard that economists are people who are good with figures but don't have the personality to be chartered accountants, so bear with me. You've heard what the subject is meant to be about, the short and longer term. I'm going to show a lot of slides, which is my want. I don't know whether that's because at some stage in my dim distant past I wanted to be a management consultant when I grew up, but I've nonetheless found it's useful to depict things in pictures, and I think the organisers will be more than happy to make these slides available for you to peruse at greater leisure, so don't be unduly concerned if I flick through things really quickly. In this segment, what I want to do is talk a bit about the Australian economy, but in so doing show a lot of other comparable economies as well, so that you can see that we're not unique in experiencing the challenges we're experiencing in the short term of high inflation, cost of living pressures, high interest rates, and the impact that that is likely to have. There are a couple of differences between our experience and that of some other economies, which I'll highlight along the way, and then I'll get into talking about some longer term issues. But of course, the expression that is on everyone's lips, the phrase that, as Paul Keating might have said, every galah in the pet shop is squawking, is inflation or cost of living. And our inflation rate surged to a peak of just over 9% at the end of 2022. And that was not a unique experience. As you can see, every advanced economy that we can legitimately regard as part of our peer group has experienced more or less the same thing. And since that peak in the end of 2022, inflation has come down quite a lot, to just under 4% in Australia. But in every country that I've shown here, inflation is still well above where central banks want it to be. In Australia, our Reserve Bank has an inflation target of between 2 and 3%. All the other countries shown here have targets of 2%, or 1 to 3%, the midpoint of which, of course, is 2. So there is still quite some way to go before inflation is down to levels that will embolden, if that's the right word, central banks to start cutting interest rates. And most central banks are petrified at the thought that if they start cutting rates and inflation then turns up again, that they have to raise rates again, because of the damage that would do to their credibility that has already suffered from their failure to pick the rise in inflation that we experienced as we came out of COVID. None more so here than in Australia, where uniquely the Governor of the Central Bank was telling people that interest rates would remain at record lows until 2024 at the earliest. And of course that's why he's not the Governor of the Central Bank anymore. The fall in inflation that we've experienced here and around the world since it peaked in 2022 is largely the result of the unwinding of the spikes in commodity prices that followed Russia's invasion of Ukraine, and the resolution of most of the supply chain disruptions that were the aftermath, the product of COVID-19 that affected the prices of a broad range of goods. But on the other hand, services inflation, which is a much bigger proportion of the CPI in advanced economies than goods price inflation is, has been stubbornly high. Part of the reason for that is housing costs, but another part is that in many countries, although Australia actually isn't really one of them, service price inflation has been driven by a rapid increase in labour costs. That's particularly apparent in the US, in the UK and New Zealand. It's less apparent here because of some of the frictions in Australia's wage setting systems that have meant that although we've seen wages rise a bit over the last 12 months from where they had been over the previous decade or so, in most areas of services that hasn't really been a major driver of inflation yet. The Reserve Bank is worried that it could become a major driver of inflation if productivity growth, which has been abysmal in Australia over the past decade, and particularly in the last 2 years when it's been negative, if productivity growth doesn't return to its average over the past decade of about 2% per annum, then almost certainly wages would become a factor driving inflation. But the Reserve Bank is working on the assumption at the moment that it is going to return to its longer-term trend. Australia's not unique in this regard. As you can see, the US is an outlier, where productivity growth appears to have picked up quite significantly. People suggest, and you will hear more about this afternoon, that the US's much greater progress in adapting AI has been an important factor in there. There may be some other factors as well. Whereas in Australia and in Europe, and to some extent in Canada, labour hoarding by employers, that is a reluctance to let go of staff who were difficult to hire in the aftermath of COVID, has meant that workers are being retained without actually doing as much work as they had been doing at the peak. And that's had some effect on productivity, which the Reserve Bank and others assume will unwind over time, and that's the basis for their assumption that productivity growth will ultimately pick up. But if they're wrong about that, then inflation will linger for longer than everyone hopes that it will. Globally, the increasing number of restrictions on trade and investment, which have seen both trade and investment decline as a proportion of global GDP, is another factor that I think has contributed to persistent inflation, because what that effectively means is less competition in the provision of goods and services and in the production of goods and services than would be the case if there hadn't been so many increased restrictions on trade imposed by governments around the world over the last 2 or 3 years. As you know, of course, in response to this spike in inflation around the world, central banks have lifted interest rates. And the normal expectation would be that that would result in slower growth, and it has. But countries' experience has, again, diverged a bit over the last 2 years. The US economy, which this time last year every man and his dog, woman and his dog, was forecasting would be in recession, isn't. Growth over the year to the first quarter of 2024 was astonishingly 3%. It's hardly changed at all from the long-term average. In the other countries shown here, the impact of higher interest rates has been more obvious. The Euro area, the UK and New Zealand have been in technical recessions. That is, they've had consecutive quarters of negative growth in real GDP. Australia has avoided that so far, but in part that's been because of the surge in population that has in turn been driven by near record levels of immigration. Again, we're not unique in that respect. New Zealand and Canada have experienced it, in Canada's case, to an even greater extent than we have. You might think, listening to the news that comes out of the United States, that the US has been experiencing it as well. But as with a lot of things that Donald Trump says, there is a huge gap between that and the facts, which are that US population growth is by no means exceptional by historical standards, whereas in Australia, New Zealand and Canada in particular, and to some extent in the UK, population growth has been the thing that's kept some countries out of technical recessions, as you can see by the gap, if you can see it, between the solid line that's per capita real GDP growth and the dotted line that is GDP growth as it's reported by statistical agencies. Australia would have had 3, possibly 4 quarters in a row of negative growth in GDP if we hadn't had the population growth driven by immigration that we've had. That's perhaps a good thing. On the other hand, the surge in immigration we've had has contributed to higher inflation, in particular of housing costs, and within that, in particular of rents. So it's been a mixed bag. I personally worry that the surge in migration here and the consequences it's having could undermine the popular support for immigration that has been a feature of Australian life and New Zealand and Canadian life, but stands in contrast to the US and Western Europe, where the perception that both the amount and the quality, for want of a better word, of immigration has been weaponised by the extreme right, which thankfully hasn't happened in this country, and I certainly hope won't. One of the other reasons why the US has been much more resilient in the face of higher interest rates than the other economies shown here is that the US has had a very expansionary fiscal policy. That is, they have been running big budget deficits, which all countries properly did during COVID. But unlike the United States, other countries have withdrawn most of that stimulus that was provided during COVID. The US has been doing this through what the Biden administration calls the Inflation Reduction Act, which has nothing to do with reducing inflation and a lot to do with subsidising particular industries, and has actually probably been a cause of inflation This year turning out to be higher than the Fed and financial markets had been expected, but it's also a significant reason why US economic growth has been faster than other economies, because it's been pumped up by fiscal policy, and you have to wonder how sustainable that is. Eventually there will be some reckoning for the US, although because the US is the issuer of the world's principal reserve currency, and lots of people feel they have to hold dollars as part of their portfolios, the US can get away with being fiscally irresponsible for longer than any other economy in the world, and don't they know it. In Europe, where the impact of higher interest rates has been greatest and where inflation has been coming down more quickly, interest rates will start to fall this year. But as you will have, if you read this sort of stuff, noticed that the Federal Reserve is now less likely to cut interest rates as soon as financial markets had been expecting, and in my view the Reserve Bank of Australia will not start cutting interest rates until February next year at the earliest. I'm not one of these economists who's reacted to the most recent inflation numbers by saying the Reserve Bank either will or should put interest rates up. They will only do that if inflation actually turns up. And that's not what last month's inflation numbers were telling us. They were telling us that inflation isn't coming down as quickly as they or the financial markets had hoped. And that means that interest rates won't come down as quickly as the financial markets or the Reserve Bank had hoped. Doesn't mean they're going to go up. Something else the Reserve Bank is of course conscious of is that they were the last central bank in the world, apart from the ECB, to start raising rates, and they've raised them by less than all of their peers. So it stands to reason that they would be later to start bringing interest rates down, as well as possibly lowering them by less than their peers. But that's all I wanted to say about Europe and the United States. I do want to mention China, whose recovery has been slower from its more protracted COVID lockdown than had been anticipated. And despite that, although China doesn't have a inflation problem, it's about the only economy in the world of any size that doesn't, there's been remarkably little by way of policy action, either on the monetary policy front or on the fiscal policy front from the Chinese authorities, as they're always called, to stimulate faster growth in the Chinese economy. India, on the other hand, has returned to rapid growth quite quickly, with only a modest increase in inflation, but having done nothing about two of its other fundamental medium-term problems, which are chronic fiscal and external deficits. And if time permits, I'll say a bit more about India's longer-term prospects when I talk about those, as I'm now about to begin to do. One of the biggest shapers of longer-term economic growth in both the developed and the developing world is demography. And demography is something that's actually reasonably easy to predict, at least over longer periods of term, even though no one picked the surge in immigration in the short term that I referred to before. But it's pretty clear that around the world population growth is going to slow, but at significantly different rates. I mean, in Japan and in China, which I'll show you in a minute, and in some other European and Asian economies, the population has already passed its peak and is contracting. Because Australia, New Zealand and Canada have and are likely to continue to have relatively high immigration programs, their populations, our population, will slow less rapidly than in Europe or even in the United States, given that its immigration program, although it attracts, as I said before, a lot of political attention as a percentage of America's population, is actually relatively small. Perhaps more importantly, the proportion of that population, which is either growing more slowly or shrinking, who are actually working, is going to decline in virtually every economy, including Australia's, even though our overall population will be growing. It's much more stark in China as an echo effect of the one-child policy that was introduced in the late 1970s and only officially abandoned about 3 years ago. And despite what's been a dramatic U-turn in Chinese policy regarding family formation, the Chinese people themselves have shown no inclination to follow Xi Jinping's thoughts on what women should do with their lives. So China's slowdown is structural. That is, it's not solely the result of short-term factors like interest rates, but it's structural. The proportion of the population who are working is falling, the number of hours that people are working is declining, and productivity growth is slowing quite dramatically, largely because the low-hanging fruit that you get, for example, from moving most of your population from subsistence agriculture in rural areas to manufacturing jobs in urban areas, most of that low-hanging fruit has been picked. And Xi Jinping is not following the same sort of economic policies as his predecessors were. He's elevated security above the interests of economic growth, and that China's economy is paying a price for that, and it will increase as the demographic factors that I referred to earlier become more intense, and there's nothing that the Chinese authorities can really do to reverse that. So I think it's inevitable that China's economic growth, which has been spectacular over the last 30 years, it's a legitimate boast of the Chinese authorities that they've lifted more people out of poverty in a shorter time than at any other time in human history. But as a result of these inexorable demographic and long-term economic factors, such as slowing productivity growth, by the end of this decade, China's rates of growth will be no more impressive than those of advanced economies with much higher standards of living. Whether that has any political consequences for China over the longer term is, I have to admit, beyond my pay grade. Something I can speculate about, though, is that we could see instability in China's exchange rate, something which would have global economic consequences within the next 2 to 5 years, because China's external surpluses, although they're still high in dollars as a proportion of China's economy, are now shrinking quite a bit. And moreover, foreign investment into China has more or less dried up for a combination of political and reasons, that is, government pressure on companies to invest less in China, but also because the business environment in China has become less attractive under Xi Jinping. Companies are making their own decisions that they don't want to be as exposed to China as they have been in the past. And the result of that, combined with factors such as that there is now a significantly positive interest differential between China and the United States, the opposite of what has traditionally been the case, means that China's at risk of experiencing significant capital outflow. And given how much China's domestic money supply has expanded over the last 10 years, whilst foreign exchange reserves have been moving sideways, China's capacity to maintain a fixed exchange rate when it's no longer running current account surpluses and when it's no longer attracting squillions of dollars of foreign capital inflow means that if sentiment towards China were to change, including from within China itself, the currency could drop quite a lot. And there would be very little that the Chinese could do to prevent that from happening. A Chinese currency crisis could be triggered by the revelation of just how badly China's banks have been affected by the collapse in the property market, in the same way that Japan's banking crisis of 1998 was triggered by revelations of how much Japanese banks had lost both in their own property market collapse and during the Asian financial crisis. Or it could be engineered deliberately by the Chinese authorities themselves in response to President Trump imposing 60% tariffs on everything that China exports to the United States. That would be a retaliatory weapon that they might have. But a big fall in China's exchange rates would have significant consequences for the world and for Australia. India's demographic outlook's very different from China's, for a whole lot of reasons that I won't go into here. Yes, India's population will over time slow, but before it starts to, India is going to become a much bigger population and economy than it currently is, but it's never going to have the impact on the world and on Australia that China did. India is still a very protectionist country, as shown by its reluctance to reduce tariffs and its hostility towards foreign investment across much of the economy. Partly because India is a democracy, sort of. It's harder to maintain the sort of long-term economic policies that were behind China's rapid growth and industrialisation over a 40-year period. India continues to discriminate in a way that China never really did against women, against religious minorities, and on the basis of caste, and in the reverse direction on the basis of caste in an attempt to correct the effects of discrimination on caste. And as I'm sure you know, discrimination, apart from being morally wrong, also has quite significant economic costs arising from locking people out of their potential to contribute to society. More broadly, the outlook for the world economy will be adversely affected by declining investment and by not so much a complete reversal of globalisation that occurred during the 1990s and early 2000s, but some unwinding of what has happened and an end to further globalisation for what are essentially political reasons. There isn't going to be much growth-enhancing reform pursued by governments either acting multilaterally, as they did in the 90s, or unilaterally. The chart on the right is taken from the most recent IMF World Economic Outlook, and it suggests some policy changes that governments could make that would improve economic growth in the short and medium terms. Of the ones that are most likely to be implemented are, well, actually not really policy changes, but things that are going to happen endogenously, such as the uptake of artificial intelligence. But the prospects for some of the other reforms shown by dots on the left-hand side are probably less than my chance of spotting a thylacine on my front lawn of a morning. From an Australian perspective, perhaps the most important challenge we face is that the gains in the terms of trade, that is, the improvement in the prices of our exports relative to the prices of our imports that have underpinned so much of our prosperity over the last 20 years, are going to go into reverse over the next 10 years as China's growth slows and as China's economy inevitably becomes less driven by the production and consumption of goods and more by the production and consumption of services that don't require a great deal of commodity input. So almost inevitably, unless we have a productivity miracle here in Australia, growth in Australians' real per capita incomes will be slower over the next 4 decades, and that includes this one, than over the past 4 decades. The government seems to think that the way of countering that is by turning Australia into some kind of what they like to call manufacturing powerhouse. Now, sadly, in Australia, history tells us that we're not very good at manufacturing. That's not because our workers are lazy or stupid. It's rather because to be good at manufacturing in a globalised economy, you need scale. And the only ways to get scale in manufacturing are either by having a big domestic market, which we don't, or like Korea, Taiwan, Switzerland, Sweden, Israel, Norway, by being very close to a big domestic market, which we aren't. And so manufacturing is a relatively small proportion of our economy, which in part is the inevitable consequence of mining and agriculture being big proportions of our economy. I mean, something politicians have trouble understanding is that the sum of the different sectors' shares of GDP can't actually be more than 100%. And the interesting thing is that during the period, as you can see, when we tried to kid ourselves that we were a manufacturing superpower by forcing our consumers to pay above average prices for what are often badly made goods, we slid from being the richest country in the world, along with New Zealand and Argentina at the time of Federation, to becoming about 26th by the time we realised what a dumb thing this was to do. And since we stopped doing it, we have risen, admittedly helped by those terms of trade effects that I referred to before, to being somewhere between 12th and 15th in the world. The reality is that in Australia, unlike the United States, Japan, Germany, or I could show Korea, Switzerland, manufacturing is a low productivity form of economic activity here. So policies which encourage labour and capital to move into manufacturing, all else being equal, will result in lower productivity, and hence in lower real living standards for Australians. That's not the case in the US, it's not the case in Japan or Europe, but what does do for me is to cast doubt on the argument used by the current government that just because other countries are doing stupid things, we should be doing them as well. It reminds me of what my mum used to say to me when I was a kid: just because your sister puts her head down the toilet doesn't mean you should do it as well. And while I wouldn't argue for a moment that the government does need to intervene in order to make sure that the transition to a zero carbon economy happens as quickly as it needs to. That won't happen without government involvement. And I also understand the desirability of reducing our dependence on one country as a single source of our imports of products that might be critical to us. I understand that. If our friends the Americans are willing to spend squillions of their taxpayers' dollars subsidising the manufacture of solar panels, why don't we buy it from them, rather than spending squillions of our own taxpayers' dollars subsidising the manufacture of things that we're never ever going to be particularly good at for the reasons I mentioned before. So sometimes I despair about the capacity of our policymakers to address some of the longer term challenges that we've had, and my conclusion therefore is that for the next 10 years, economic life in Australia is still going to be something of a struggle. Not as much of a struggle as in some other countries, but still rather difficult compared with what we have led ourselves to expect. My apologies for taking a little bit longer than I'd expected, but hopefully not too much.